I believe every business owner should understand what their business is worth. I'm commonly met with the rebuttal, but Jackson, I've got no intention to sell my business anytime soon. What does knowing what my business is worth, how does it benefit me in any way? I'm going to help you understand why knowing what your business is worth is going to guide you in all of your decision making in your business to help you maximize your profit, buy back your time, and ultimately build personal wealth faster. So let's get stuck in. So when we look at a business's valuation, most businesses are sold at a multiple of recurring revenue or of their EBITDA, their earnings before interest, tax, depreciation, and amortization. This is ultimately a true measure of profitability in a business before our accountants get their grubby little hands on. The reason why this is important is because an acquirer of your business is acquiring future cash flows. Like an investor, if they're buying an investment property, they want to buy the ability to produce rental return, and they ultimately want to maximize their capital appreciation. And in a business, the earnings before interest, tax, depreciation, and amortization is truly the main measure of what those future cash flows are likely to be. Now, for many businesses, that number is typically between 1 and 5 times that EBITDA. And for most businesses, let's say meet in the middle at about 2.5 to 3 times. That ultimately means that your valuation multiple is a magnifier for the decisions that you make in your business. For example, if you are making decisions in your business that are eroding profitability because you're reinvesting back into growth, then that is going to be 3 times the impact in the depreciation of your business valuation. Conversely to that, if you're doing things that are increasing your EBITDA, so you are improving your cash flow, you're maximizing your cost to serve, so you're increasing your profitability, then any of that uplift in your profitability is going to be magnified 3 times. So why is this important? Well, as a business owner, we are often emotional creatures. There are decisions that we make for reasons that are not necessarily for the immediate financial benefit. We may convolute it to say that it is for an immediate financial benefit, but the reality is most of those decisions are made because of the way it makes us feel. We do things to pat our ego, we do things that makes us feel good, makes us feel important, all of these kinds of things. I've been in this position myself, and I've created lots of various assets and resources in my business that haven't made us any money because I've got ADHD. I like creating stuff. I like the idea of pursuing what I think are good ideas. However, for a very long time, I didn't have an objective measure of the ROI that those things were generating. What I started doing is implementing a monthly valuation methodology. So what that involved is looking at all the businesses across my group, understanding the profitability of those businesses and the market multiple in which each of those businesses was valued by, looking at the normalized financials of a rolling average over time, working out what that business was worth at that particular point in time, and then each month seeing whether the business value had improved or declined, and then justifying why that was happening. In some cases, the valuation would go down, and I'd have to confront my business partners and basically say, look, I made these particular decisions. They didn't pan out the way that I'd expected. As a result, we've had an impact in our valuation. Here's what I'm going to do to fix it, or here is what I've learned. Or the valuation has increased, and this is the reasons why we've been able to manufacture that value, because we've increased recurring revenue, we've maximized top-line revenue, we've been more efficient in terms of costs, whatever the justification might be. Now, you may not have business partners, but you can do this yourself. And the idea is what we want to do is we want to understand the baseline of our business. So if I've got a multi-6-figure or a 7-figure business, we want to use a tool. If you jump in my bio, wealthhealthcheck.com.au, if you register, you get access to our small business valuation tool. It'll give you a crash course on how to value your business and work out what are the value multipliers that you can use to improve the value of your business. Let's work out the baseline. See what our business is worth right now. Next, let's evaluate what we are ultimately working towards. So let's say, for argument's sake, I waved the magic wand and you had the ability to sell your business in 5, 10, 15 years, whenever you wanted to be financially free. What is the magic number that you would ideally want to walk away with? Let's say, for example, it's $3 million. And let's say your business is valued at 3 times. That means you need to get $1 million per year in profit in order to sell your business for $3 million. And then what you now need to do is say, okay, well, what are the strategies, the tactics, the actions, the decisions that I need to make that are going to get me from my profit right now to the profit that I ultimately want to be at? And is there any ways that I can manufacture equity by increasing the valuation multiple? And we typically do that in a number of ways, which I'll cover in a separate video. This quantifies the value of your business. This helps you create a strategic lens to filter your decision making in your business. It gets you out of making emotional, ego-based decisions, and it gets you bolstering your business valuation, which will get you to financial freedom faster. Let me know your thoughts in the comments, guys, and catch you next time.